After the fall we suffered in September, it looks like the market is recovering well in October. However, there is one key uncertainty plaguing the market, and that is inflation. With the Trans-Tasman figures showing that they had an increase of 4.9% through the September quarter, will be interesting to see the whole of Australia when those figures are released later today being the 27th of October. But the argument is around whether the inflation is transitionary or permanent. That is, will we see deflation once shipping and freight returns to normal, or will it continue to grow as Australians have a newfound wealth thanks to the low cash rate and their first taste of QE? The RBA is holding strong at their 10 basis point cash rate and originally said they wouldn't be looking at raising those rates until 2024. However, we have already seen that the 10-year bond rate has increased to 1.8%, and we expect to see it at around 2.5% probably by mid next year. This means we're going to start seeing upward pressure on bank lending rates, and why we're starting to see those generous fixed term bank rates disappear. Commercial real estate is in a bit of a battle at the moment, as we're seeing rents decline across Sydney and Melbourne markets. As businesses realize it's a lot cheaper to have employees use their own electricity and work from home. We might start to see this come back to normal levels if work from home arrangements diminish over the next couple of years. Aussie and global equities have had a great run for the last 12 months, or really since, April last year. And we might see the retail sector have a good boost of enthusiasm leading into Christmas, provided the goods are there to buy. However, if we start to see interest rates creep up, we might see a wash off of valuation for high PE stocks. The reason we'll see this valuation wash off is because of this formula. This is used to work out your required rate of return, and then you use that to work out the valuation of a stock to decide, what is fair value, and from there, if the stock is overpriced or underpriced. The part that is under pressure is this bit here, the risk-free rate of return. As soon as that increases, it will increase the required rate of return, which is what the fair value of the stock is estimated on. So potentially we'll see a fall in valuation of some tech stocks and those that have loaded up on debt to grow their business, but are not yet seeing a profit turn from those investments. We've started to see slowing in China, and the media are blowing up the Evergrande story when it only amounts to 1% of the infrastructure building market. And most likely, China will stick to their guns and make an example of the company. But at the end of the day, Evergrande's balance sheet is strong enough to cover itself if it had to liquidate. Crypto is tracking strong, but we've seen it move away from the altcoins and just back to the main ones. So Bitcoin, Ether, and Cardano are making great returns, and our little friend SHIB, for some reason, is coming off its lows that it suffered about 2 months ago and is looking at about 500% up with no signs of slowing down for no reason at all. There looks to be no stopping the crypto juggernaut now, and then it's likely spurred on because of the range of ETFs that are available in the US that track the price. However, you've got to be careful when purchasing an ETF, especially the US available ones. Some actually hold the asset, whereas some are just using derivatives to mimic the return performance. Well, that's all for my market update. Hope you enjoyed it and look forward to doing these every month moving forward. Thank you.